Hello, everybody. Welcome to another edition of the 1Million by 1Million podcast. This is Shramana Mitra. I'm here today with Yipeng Zhao of Embark Ventures. Yipeng, welcome to the show.
Thanks for inviting me. Glad to be
here.
Yipeng,
let's start by helping our audience get to know you. What is your background and what is the focus of the Embark Ventures investment thesis?
Okay. So my name is Yipeng Zhao, and I'm a partner at Embark Ventures. We're a Santa Monica-based early-stage venture fund that are doing seed and small Series A investment. Our investment thesis is around what we call deep tech or frontier technology companies. So basically, we believe in venture investment that supports transformative technologies that are defensible, as well as have very innovative business models. So we write checks up to $2 million, but as small as $250K. So sweet spot will be $500,000 to $1 million-ish. So we closed the fund early last year, in the February-ish, and made our first investment in March. So it's a brand new firm. So looking forward to talking a little bit more about our fund.
And how big is the fund?
The fund is $45 million.
Okay. And are the LPs Chinese LPs?
We have a very broad LP base. We have a Hong Kong and Chinese LP, and we have also US LPs as well, and local LPs.
Okay.
So,
okay.
Yep.
So it doesn't have a particular China angle.
Not really. Although I'm Chinese, so I can definitely provide values in Asia for sure. So
yeah.
And my partner's he was born here, but he's a Korean. So we can definitely provide some Asian angles there if needed. But the fund doesn't have to be, the company doesn't have to have a Asian angle or anything. So
got it.
Yep.
Talk to us a bit about what types of companies, sector-wise, B2B, B2C,
right.
Any particular
right.
sector interest? Where do you like to invest?
Okay, I'll start with our sort of investment thesis. So
yep.
Our thesis is around what we call deep tech or frontier technology. So by that, what we mean is companies that are, have technology that are defensible, whether it's from IP or, trading secret or just industry expertise, right? So typically the companies we're looking at have, are basically coming out of a university research or company research, or basically, founders been working on the problem for a couple of years in whether a lab or whether engineer work, right? So that's our thesis, basically defensible technologies around good business models. So that's our thesis. And in terms of sector focus, we are broadly focused on three broad sectors. One sector is what we call security or cybersecurity,
yep.
particularly enterprise-focused cybersecurity. Mostly B2B. We don't do a lot of consumer cybersecurity, but mostly enterprise security
yep.
or cloud infrastructure security. So that's
yep.
the one sector we can spend a lot of time on. And another sector is what we call automation, right? So it's basically technologies that make things more productive. That could be robotic, AI, machine learning, or even data analytics, right? So that's basically the tasks that are, whether it's industrial automation or personal automations, basically make people's work or life more productive. Right? So that's our sort of second focus. And in that sort of sector, we're still more in B2B focus or enterprise focus rather than B2C. So I guess more B2B on that sector. And the third sector we're looking at is broadly healthcare related. That's basically healthcare, IT, and a little bit biotech. So and the healthcare IT piece are very easy to justify. That's more of your AI used in healthcare or a new way to do the file management for hospitals, all that stuff. So still more like B2B.
Yep.
And the biotech piece are more using new biotech technology. In the space that other than pharma. So no pharmaceutical product, no drug development. So we invest in companies that are, doing medical testing, diagnosis, right? Cancer testing, all that stuff. or even like agriculture tech that use biotech, right? So, but no pharmaceutical, no drug discovery. So still more like B2B. So I guess overall, all the three sectors we focus on are relatively B2B focused. Although, like, you know, we won't say no to a B2C company if the company has some amazing tech, right? So, but broadly, I would say that 90% of the fund is focused on B2B and enterprise.
B2B.
So,
got it.
Yeah.
Okay.
And enterprise. So.
And enterprise. Okay, very good. We have many companies that fit that profile. So what about geography?
Mm-hmm. So I would say we are a Southern California-based fund. So we spend most of our time looking at company in Southern California. By that, what we mean is, you know, that obviously Los Angeles area is where we're based. Our headquarters is Los Angeles. But, you know, like we also look at from Santa Barbara, which is a little bit, I guess north to the LA County, and also down to Irvine and San Diego. So that's sort of like broadly we're looking at is, you know, from Santa Barbara to like, you know, San Diego. That's broadly. We spend about, I think, 50% of the time, you know, in that space or that location. But we also spend a little bit of time on the Bay Area as well. So we have two company we already invested in our headquarters in Bay Area, you know, San Francisco or you know, Palo Alto and stuff like this. And for Bay Area deals, we will never lead a deal in Bay Area just because we are a little bit far away from there. But for Southern California deals, we do lead deals in Southern California. And, you know, we start getting into more like other, you know, emerging market like Boston and, you know, Texas. But we haven't really done any deals in Boston or, you know, Seattle or Texas, other locations. Although we have a venture partner in Boston, so we try to spend a little bit of time in Boston as well. So.
Okay. All right. Talk about what trends do you see in your deal flow? You've been investing for about a year. What have you've seen a lot of deal flow. What have you seen in this deal flow that can be synthesized as key trends?
Yeah, I mean, it's a very good question. So we see a lot of different trends on different time, I guess. So, for example, I think last year was a lot of AI companies coming out. A lot of AI applied in any other in some other industries. Like for example, it's AI for like medical imagery, and this like AI for workplaces, all that stuff. So AI is definitely a trendy topics we've been seeing on deal flow. And this year, you know, I guess blockchain is definitely picking up the pace. There's a lot of blockchain companies, and you know, robotics is definitely one thing we're seeing. A lot of deals are coming from or doing like some sort of robotics or you know, application robotics, and you know, so that's sort of like definitely the hot topics we've been seeing. But you know, because we are based in LA, you know, we also see like a lot of just consumer goods and you know, entertainment and stuff, right? So which we don't really invest, but we're still seeing a lot of deals in the, you know, consumer app or consumer product, and also just entertainment related media companies as well. So you know, but so I mean, I think the trend is always changing. So every couple months you see a different trend.
And what have you invested in? What are the highlights of your portfolio that you're particularly excited about? And as you're describing them, tell us also about what is it about that company that really clinched it for you?
So, you know, since we closed the fund, we have 6 portfolio company already. You know, I mean, we probably do like once every 2 months. You know, some of the company, to be honest, is still in a stealth mode, so I can't talk too much about it. But I would just maybe give a couple example of companies we invested in that are, I guess, actually announced or publicly known, right? So, for example, one company we really like is a company called Embark. So they just announced their financing. It's basically a automation for warehouses, for small to medium, or you know, a little bit large warehouses. So that's one of the sectors we really spend a lot of time on. It's automation, and we really do believe warehouse automation is the future of the industry, right? So you know, since Amazon bought Kiva, it's sort of like disappeared a little bit, right? So there's a lot of demand for you know, warehouse owners and e-commerce sites and all the other, you know, different warehouses that has the strong demand of having automation system in their warehouses, right? So and a lot of them couldn't spend millions of dollars to make the new infrastructure of the warehouse, right? It's the ROI doesn't make sense, right? So our portfolio company basically sort of like developed a way to do retrofitting and make it to make the ROI more feasible to small and medium-sized warehouses, right? So everybody can basically deploying robotic in their warehouse and and make it cost efficient. So that's one company we really like, and it's also as one of our core focuses around automation and make the workflow more productive, right? So, and another company that we invest in is a company called GCO. It was basically a new bank infrastructure to make a more secure and private bank. So there's a whole bunch of cybersecurity issues, a whole bunch of hacks going on with different banks and credit bureaus. I'm pretty sure you heard about a lot of this different issues, right? And banks selling data to other people, all that stuff, right? So the company is basically developing a new distributed infrastructure to sort of like make you control your own banking data and make it fully secure, or at least like more secure than traditional bank, and hopefully cheaper than traditional bank as well, right? So that type of infrastructure, cloud infrastructure, is something we really like and really feel excited about. And we have another company that are doing a semiconductor for AI. I can't tell the name now, but so they're basically making a edge computing semiconductor chip for IoT devices or for like local computing devices. So which is for us is a great area. As I said, AI is, how do we think about it, part of automation and part of making it more productivity. And edge computing is definitely the trending things we've been seeing on IoT and on AI space, right? So after a whole bunch of cloud infrastructure and cloud semiconductors being made by Intel, NVIDIA, all these other folks, there's a big almost like a vacuum in the edge computing space for AI, right? So we really strongly believe the edge computing in the future is going to be big in the future. So that's a couple of highlights of the portfolios we have done that we can talk about, and there's a couple others we invest in, but we can't really talk about it right now. So
okay. Yeah. And what when you say you are comfortable investing $250K to 2 million check sizes, what do you want to see in terms of validation to be willing to invest?
Right. So I think it's a lot of the time it depends on the stage of the company. So it's no like a one answer fits all type of answer. So I guess we can do anywhere from idea stage, which we call like pre-seed. So basically a smart entrepreneur, a smart team that has an idea and has a tech. Obviously, we are very focused on the deep tech stuff, right? So has a great tech that they developed or great engineer work that they have, right? And but they don't really have a prototype. We can actually go in that early, but typically that will be a smaller check and lower valuation, all that stuff, right? So, but in that sense, the validation we're looking at in that stage will be more like the team. So the team has to be amazing for us to really make the bet before saying anything, right? And also we have to understand the future product and the future value proposition and the product development pipelines, right? So the milestones they have to achieve. So for this kind of companies or for like super early stage or like pre-seed, that's what we're looking at. And for our core bets, which is seed and like more like a slightly larger round, we typically would want to the company have a more like a prototype or like a proof of concept type of deal. Doesn't have to have revenues, but we would love to see some of the proof of concept or a basic prototype, right? And I guess the very good analog we give to the entrepreneur is with this round of financing we're participating, hopefully they can have one paying customers after it, right? So they can be a little bit before they have revenue or before they have customer, but hopefully after the race they can very soon have the one customer or have one revenue stream, right? So and that's I guess to validate that idea, we normally want to see the prototype. We normally want to see the proof of concept, and hopefully, slightly revenue. But revenue is not really, I guess, a requirement, right? So that's another sector, or another stage. But we also do a little bit of like small Series A deals, which we look at revenues and all that stuff. Yeah.
Okay. And talk to me about TAM. In the Bay Area, we see a lot of companies, funds of your size, still chasing unicorns. Are you chasing unicorns? Are you looking for these $1 billion plus TAM deals? Or are you also open to investing in companies that are working on maybe smaller TAMs, but could be very compelling, solving compelling niche problems that will be $200, $300 million TAM, maybe $100 million TAM, but have to be done differently as a capital efficient venture, exited early, etc.
Right. I mean, I think different people have different opinions. So for us, we definitely believe the unicorn type of company as a venture investor. Doesn't have to be, I guess, our definition of, just because we are a smaller fund, right? So our definition of a unicorn is a little bit different than, Square or Benchmark, right? So, the company in our portfolio doesn't have to be sell to $10 billion or whatever, right? So, a couple $100 million actually could be good for us, could be very good for us, especially given we are invest early. But I guess we definitely want the company have a potential to become a unicorn. So we don't want to invest in a small exit type of company. That would be the short answer, because I think there's a couple thought process on that. This is, I guess one reason is because, we do believe venture model is built on the high risk and high return type of company, right? So it has to have a very big potential in order to justify the risk, right? So that's one thing we really think that determines our perspective looking at unicorn. Because if you look at all the asset class, venture capital is really one of the most risky assets you can have, right, on your portfolio. So if that's already super risky, and if you're not chasing the big return, then it's not really justified, right? Because even the smaller exit.
I think the issue is that the market is so flooded with micro VCs right now. In just the last 5 years, there are 700 micro VC funds, and if everybody is looking for unicorns, it's just mathematically unviable.
Yeah. I agree. I think that's why I think the definition of a unicorn for us is different than the definition of a unicorn people really think about, right? So I think for us, the unicorn could be a small exit, not a small exit with a couple $100 million, $300 to $500 million. Where that's not a unicorn for Square, for Benchmark, right? So I think for us,
but that is not the definition of a unicorn. A unicorn is defined as a $1 billion market cap company. What you are looking for is a 10x return, which is not a unicorn necessarily. You can get a 10x return on a company that has a much smaller exit, much smaller TAM, much smaller exit.
Yeah, but I guess my point will be we are still looking for unicorns, right? So it's not we don't have to have a unicorn to make the fund, good fund, but we have to look for unicorns.
So you're still looking for unicorns is the basic point. There are a lot of funds actually right now that I'm talking to that are looking for
smaller exit,
smaller exits and smaller opportunities to not compete in that same pool where all the unicorn seekers are competing, which is a very competitive pool.
Yeah.
Okay.
Which actually got it. That's also very good value proposition.
Yeah. And what do you think of the Series A gap? There is 100,000 seed investments and 1,200 to 1,500 venture investments. How do you process that?
So you mean I guess a gap between series seed company to Series A company?
Seed and Series A, yeah, right.
Yeah. So, my opinion would be there's always a problem there. Even before, seed and Series A is always a big hard gap, and the most companies died after seed, and just because they can't reach Series A. So I think by nature of the business, you will always say most companies die after seed, right? So I don't think that's because of the structure of the business. It's just because of the nature of the business, right? Because as I said, I think venture, startup is just a very high risk business, right? And most of the time companies die quick, right? So which is actually great for venture investors. So I think the gap between seed and Series A is not really an issue, just because you don't want the bad company to get funded, right? So seed is more like a testing phase, and Series A is more serious, right? So if the company is not fundable at Series A, there has to be some consequences, and the consequences in the startup world, it will be the company just die, right? So I think
So I have a completely different perspective on this, by the way. I don't at all have a venture capital perspective. I take the perspective of the entrepreneurs, and my perspective is this, that it's not like these companies need to die at all. It's just that they need to be built as non-venture funded companies, as more bootstrap companies, maybe a little bit of angel funding or seed funding, but largely bootstrap companies. And you can build very nice businesses, very nice profitable businesses, potentially small exit businesses using, across these broad numbers of companies. So I think the venture capital industry has a very arrogant perspective that all these companies that don't fit the venture model are bad companies. They're not bad companies. They're just not high.
I'm not saying that. So I guess I'll say this way. So since the content is about venture Series A and seed fundings, I will say if the company decide to raise from venture at the seed stage, they have to sort of like understand the consequences of venture-backed companies.
That is correct.
I think that's what I'm saying, right? That's why there's a gap, right? So if the
and it's very poorly understood. I think the problem with the industry is that all entrepreneurs think that they should all raise venture capital, and that's a flawed assumption.
Yeah. That's actually why one of my biggest advice to most of the company is if you are not venture backable, if you are not a high growth company, just don't take money from venture capital. There's whole different other resources, right? You can be very profitable. You can be like, the venture funding doesn't help you if you are not if you don't want to go through the traditional venture route, right? So there's so many different other sources. There's family office, there's like banking, there's loans, there's FDR loans, there's like NSF fundings, right? There's so many other resources that can make you to a great company, right? So it doesn't have to be a venture-backed business. But I would say if the company decide to take the money from venture capital at seed, they have to sort of like know the consequences. Because, if you
take venture capital, then you're going to need to go to $100 million in 5 to 7 years. That's the requirement. And that's how the venture capital model works.
Yeah, and I really want to, I think we are very, I guess, like, honest person in terms of like venture capital. We just tell the entrepreneur whatever we think that's the truth. What do we think is I think for venture capital, it's better for the company to die faster, rather than just being almost like a living zombie at some level for venture-backed business, not for every business, but only for venture-backed business, right? Because we have a very short period of time of the fund to give back to our LPs, right? So we can't hold the company forever. So if the company is really, you can always feed the company a little bit of money to make it work for another year or for another 2 years. You can always do that, right? But in that case, you sort of like drag down both parties, right? For the entrepreneur, they can have better things to do other than working in the company that has no chance to hyper growth, right? And for venture capital, you sort of like get into the business where you can have to keep working with them for another 10 years, right? Which sort of like drags down the exit pipeline, right? So that's why I think a lot of it's unfair to the entrepreneur just because of the very weird structure of venture capital. But sometimes just to have to deal with this unfairness, just because venture capital also have LPs, also have investors, right?
Yeah,
so we have a pressure from other investors as well. Yeah.
That's right. And part of the problem is also the industry is full of bad VCs who make bad investments. And as a result, the entrepreneur gets caught in this, trying to fit a square peg in a round hole situation, which is completely unhealthy and completely unproductive.
Yeah, especially at the seed stage, I would say like that's very common. Now I think, especially with all this, like, I don't say it's bubble, but like it's very easy to get a seed funding now. Like you can easily get a seed funding even you are not venture backable. Like as you said, it could be a very good business, but it can be
not a good
very
investment.
hyper growth, not great venture business, right? And these guys all raised from venture capital, right? So which is actually bad for them, not bad for venture capital.
Yes, that's correct.
For the entrepreneur, they could be a very amazing business, profitable business in 2 years, but since they take the money from venture capital, the VCs is pushing them to spend the money to go hyper growth, and then they end up just going to this bad circle, right? So yeah.
Right. All right, Yipeng, that's great. It's very good perspective to keep bringing to the investors. I harp on these points constantly to keep our entrepreneurs, understanding what are the dynamics of our industry. So thank you for reinforcing those points. And thank you, audience, for listening. You're very welcome. Thank you, audience, for listening. You are very welcome to stop by at one of the working sessions, the free public roundtables, where we do the project-based mentoring. Go to the 1Mby1M.com website and go to free public roundtables. You can register to pitch or attend. And I look forward to working with you on one of those sessions. Thanks for listening, and we'll be back with another edition of the 1M by 1M podcast.